Welcome to the Breakneck Podcast, episode 42 with myself, Ian Sweeney, and my co-host, Matt Pashensky. Say hi, Matt.
Hello.
So this week we are going to tap into a big question that people have been asking for a long time. Is AI a bubble? So with that, Matt, what is your response?
Maybe.
Oh, no. The definitive answer from Matt Pashensky.
Yeah, let's look at the most bubbly aspect of the AI wave, which is, let's say, NVIDIA's share price, right? It's very liquid. It's a clear number. And they've gone from being worth a couple $100 billion to $4 trillion in very short order. And so if I were going to pick one particular segment of the economy, that looks the most bubbly. But on the other hand, they're producing a huge amount of free cash flow, and they have 90% margins on the most cherished item in existence. And so when we talk about bubbles, we can talk about a misvaluation of future cash flows for a company like NVIDIA. Maybe they won't grow 2 or 3x again. They won't be able to maintain their margins. In that case, the valuation is too high. But on the other hand, if you were to just look at like their actual cash that they're producing each quarter in terms of profit, it goes up really, really fast. And so I think when we talk about bubbles, we all bring what we saw in the year 2000, which is the rise and then crash of the companies like Amazon and Yahoo and so on. But those companies were not producing cash. Those companies were, hey, maybe this is going to be a big thing. Maybe people are going to enjoy this. People already do enjoy NVIDIA chips. I personally consume huge amounts of services based on NVIDIA chips. Do I pay too little for them? Or is the cost going to go away? Those are questions about future valuation, but it's not the same thing as zero revenue companies raising on $2 billion valuations. But there is that too. And that's a second part of the bubble, which is, companies going out and raising $1 billion pre-product. I'll pick on one company of a person I really respect, which is Bret Taylor, which was the person who invented the Google Maps, or at least he was the one who brought it into the world famously in a weekend. So great engineer, ended up becoming the CEO of Salesforce, left that role, made Elon buy Twitter. So this is like a big shot, right? He raised $1 billion pre-product, but he has hit $100 million in revenue in 7 quarters for his company. So when I saw Sierra is his new AI company. When I saw him raise that, this is a bubble. On the other hand, now he has $100 million in revenue, and 10x multiple on revenue is high, but or I guess they're at 40x, whatever their old valuation is. 40, 50x revenue multiple is high, but not on that ramp. You can kind of like draw the line, 3-4 more years at that rate. Imagine that their margins expand, and then you have a very nice enterprise company. So it's like, yes, it's bubbly in the sense that $1 billion pre-product of fund, at a $4 billion valuation, that's an insane valuation. On the other hand, I don't know, he's able to do it. So, and you look at Anthropic's revenue, you look at OpenAI's revenue, they're all growing extremely fast. It assumes a lot of continued growth, but there's something there. So you can't just say outright, like, this is fake.
Yeah. So let's define a bubble. So a bubble is a situation where you've had investment go into something, it's driven up the supply of that thing, and then the demand is not yet there. And the market says, well, if the demand's not yet there, either demand never will materialize or it's not going to materialize in a period of time that's adequate or appropriate for our investment. We're going to get we're going to get out of this position, and we're going to get out of it very quickly. And a lot of people, the sentiment changes. And so the bubble precedes the crash. And so I think you and I agree there's probably 2 levels at which this could happen. There's the infrastructure layer, NVIDIA, data centers, etc. And then there's the application layer. We're in the application layer, you and I, so I think we're kind of well positioned to understand that. But if we go back to the infrastructure layer for a second, and let's talk about NVIDIA. NVIDIA, you were talking about revenue multiples. As far as I know, their valuation, their market cap is not It's at, I think, 37 or 38 X of their revenue, which is not the highest that they've ever traded. And so that does not suggest a bubble to me. It also then, when you look at we talked about this sort of circular investment as well in the application layer, in the infrastructure layer, which is interesting. And it's not to say that is not frothy in there. You have so you have your Microsofts and you have your hyperscalers who are buying from NVIDIA. As far as I understand, a good portion of that investment or that spend is coming off their balance sheet, and maybe a little bit of debt. But if you take that hyperscaler level of customer, they're all pretty solid, right? They're not going to fall over and die. The question is, who are the second level of customers? OpenAI probably wants to be included in the hyper layer, but I don't know if they are. And it was interesting. I had a conversation with a buddy of mine who's in data centers. And you can imagine the amount of demand they're seeing. It's enormous, up and down the scale. The bit they're worried about is an OpenAI, a large startup who has a bunch of money in their pocket right now from investors who's saying, yeah, I want to buy this stuff from you. I want a long-term lease of this data center. And the data center guys are looking at them going, wow, are these guys going to be around? But again, at least half of their customers presumably are the hyperscalers. So it's not as speculative as it was at the infrastructure layer, I think, compared to, say, 2000 or 2008, the financial crisis, a different type of dynamic. But again, two very speculative phases of our market.
Yeah, when you look at the price to earnings ratio, like you said, it's 42 for NVIDIA. The kind of like standard for a tech company is 20 to 25 over the last 6-7 years of price to earnings. The problem for NVIDIA is that, yeah, they have very high revenue concentration, but with, big companies, we can talk about Google just made a deal with Meta. So Meta can train their models on Google's proprietary chip, which doesn't use CUDA, doesn't have NVIDIA chips. So I think if you look at a company like Google, which is at 3.8 trillion, and NVIDIA's 4.17 trillion. You like Google a lot more they have a diversified set of products. They have a very large consumer base. They have a growing enterprise business. So you kind of like, oh, that's a nice business. But then on the other hand, NVIDIA is a much more pure play on the hottest technology in the world, and it's going up very fast, and they just beat earnings again in terms of sentiment. And so, but again, we're not talking about a company valued at zero revenue at, some insane amount, or, like buying Warner Brothers or something like that, like back the AOL days. There's legitimate stuff. These guys build something that is extraordinarily complicated, has lock-in in some ways, is in huge demand. There's risk, but then it's going up straight up, and it's, who knows what's going to happen next? Is every human being, if you go listen to Jensen Huang, is every human being going to have his own or her own AI assistant with a similar level of capability? Well, how many chips do you need to provide that? Like, I want that. Please give it to me. How many chips would that take? It's a lot more than they're producing now. And so there's a bull case that this is real. Anyway, what we're talking about is not unmoored investor demand for stock without fundamentals. It's like, there's something there. It might be high. They might be paying too much for it, but there's a legitimate business behind it. And that's not what we were really talking about in 2000. When you look at like the credit default swaps in 2008, that was just basically like people forgot who owned what. It was not necessarily a legitimate business that people had just overvalued. So I think,
yeah. So we should talk about we're talking about the positive here. Let's follow that track for another minute and do the comparisons. You talked about demand is definitely there, and demand will unlock further at the application layer. As long as the application layer keeps going as fast as it is, then more demand will get unlocked, because you've really creative people like you and I, right, doing new stuff and saying, oh, we could use it over here. But so the demand that's there today is great. There will be more. If we go back just down to the infrastructure layer, the difference between now and 2000 was the reason we've gone from zero to these we don't even talk about hockey sticks anymore. It's not a hockey stick growth. It's just like straight to the moon type of revenue growth. The reason that was possible was the demand was there, but the infrastructure that was there that was created in 2000, right? In 2000, we're like, oh, pets.com is great. But actually, I don't even have dial-up yet to the internet, right? I still need the infrastructure to roll out to me to create that demand. That is not the case. The core infrastructure was there to deliver this new technology. So demand and infrastructure exist. Infrastructure, the NVIDIAs of the world are being, their customers are relatively solid. Let's say there's a good portion of them that are solid. But let's talk about the negative side. Like, where could things go wrong? Let's talk about the application layer. If investment stops, and I think we're reasonably well placed here to understand the investment market in the application layer, if that were to slow down, what might that mean for, and sorry, to also talk about this, a huge portion of the investment in the marketplace today is AI based. I mean, if you read all the headlines, AI is kind of holding the market upright here. So it might not take a lot of a shift to happen. So Matt, do you think that might happen at the application layer, that things slow down, the investment slows down?
I tend to maintain my view that if all progress in AI stopped in terms of the quality of the models, we still would have 10 years of catching up to just integrate what is possible now. And I also think that I consume AI services that I'm essentially paying probably 5% of what I would pay. And I'll go back, our last episode, like literally the last episode we had, I went on a rant at some point saying, if we could just have something that created slide decks for you automatically, that would be life-changing. And for a lot of people, it would be life-changing. I've met people who are not great at business, but were great at making decks. They did very well, and often better than I would do. So something like just creating marketing materials, slide decks, and things like that. I said, if that was in a year, if we could have that, I could just talk to the computer and it would pop out a slide deck. That would be life-changing. Later that day, I'm watching the video you published. I'm watching on YouTube. Got lots of likes. I was very excited about it. I get an email from a client, and he's just sharing the videos that he was making to market his company, and he was using Notebook LLM by Google, which we've used. They just added the ability to make slides that are integrated. So you can just put in some documents or maybe like a phone call, whatever. You just jam it in and it will produce a marketing presentation with slides in a video today, right? I've worked in a lot of different companies over the years. Like, how many people's job will that remove right now? Like right now, like at least 10 people at any company over 200 people, right? Like just immediately 5% of, and those people will now have other things they can do. They can be creative with these tools. But in terms of just Notebook LM's ability to create video slide decks, we've already crossed that threshold. Nobody I know is using it. I just saw this yesterday after lamenting on my what's happening in AI podcast. I just had not seen it. And now Notebook LM's added this feature very quietly, and it will take over all that stuff. Now, then you go backwards from the application layer. That's something that is already good. It's already sufficient. We could release that and not improve it for 10 years, and it would become a standard. Well, how much power, chips, and everything does that consume? Probably quite a bit. It's pretty sophisticated. How much would I pay for it? My number in the video before I had seen this product in the wild was $1,000 a month. That's easy. We pay people $15,000, $17,000 a month to do this at many companies. And then you work backwards from there. Like, does that pay for the chips? Absolutely, right?
So I agree. There's plenty more applications to be built of this technology that exists today. Nothing new needs to come out in order for us to have a full decade worth of building new products to harness this. But in order to do this, we need, or in order to do this sustainably, I guess we need two things. We need the investment, and then we need to operate at a place where we're making money. And you kind of alluded to it earlier, where many of us are operating on credits, and we're operating on other people's money.
Mhm.
So the question then becomes: is that investment money going to tighten up? And you and I have both been out there raising money in the last 12 months. Is the investment market for startups frothy today? Because if it is, that's potentially a situation where there is a bubble, and if that money disappears, many entrepreneurs won't be around, won't have the money in their pockets to pay people to build these applications.
Yeah. So, let's just break down the chain of logic. It's like NVIDIA's created these chips. OpenAI created this AI. Anthropic, Google have AI now too that matches that performance. So that's the infrastructure and base model layer. Then we have the application layer. So I think there's still a lot of investment going into the base model layer and even in the infrastructure layer. People are raising money on different types of chip architectures, and this one called Extropic, which is, I don't know, I'm a physicist. It seems like a load of shit. I mean, like, whenever I see like stochastic, I'm like, that's not why computers are good. You don't do stochastic. There's a way to simulate stochastic that's going to be far more efficient than building a stochastic chip. But they raised a bunch of money, right? So there's still a lot of investment into that base layer. Why? Well, because NVIDIA is worth $4 trillion and OpenAI is worth $1 trillion. So it's like, it's a $4 billion valuation. But yeah, let's say there's a 1 in 200 chance that they succeed. That's a legitimate valuation for a 1 in 200 chance of becoming a $1 trillion company. And there are trillion companies, just $1 trillion companies popping out of, like Meta became a $1 trillion company. Now OpenAI is a $1 trillion private company. No one's ever come up with a unicorn. When it's a $1 billion private company, it's a unicorn. When it's a $1 trillion private company, it's just OpenAI. But like Anthropic will probably get there looking at their growth rate. So it's like, are these irrational or no, they're just a much larger numbers than we were used to before.
But are
And
they outliers is the question.
I think there's bad investments being made, but also it's like if your winners pay for your losers, then it's not a bad investment because your a priori understanding of the market doesn't have to say I win every time. It's just I'm going to make this distribution of bets, and I'm going to get winners. And so in a year, I would not be shocked if like a lot of these investments go absolutely zero. I wouldn't be shocked if a lot of VCs investing right now have bad returns. But on the other hand, things go a little different and they get 2 or 3 winners at $1 trillion. It's just like, boom, that pays for everything 10 times over. So
Which
it's
has
hard to
been the
say.
way, yeah, which has been the way that VC always operates with those sort of return numbers, right? The one return returns a fund type of a thing. But
Yeah.
it would concern me. I'm going to answer my own question. Is the venture investment market frothy? I think the answer is no. Many of us entrepreneurs are bemoaning the fact that we have this much revenue, and if we'd had that 5 years ago, we would have been able to raise a shitload of money. But now you don't need you don't need 100K to raise a pre-seed. You need $1 million to raise a pre-seed. Whatever the numbers are, you can make them up.
Pre-seed, you can,
Yeah,
by
that's maybe a little
definition.
bit high, but but
No, I have a friend with $250,000 in revenue raising pre-seed, and it's just like,
yeah.
yeah, you go
So
get the revenue.
but you need those. The bar is much higher now to raise. And look, numbers like what used to be A is now C. Blah blah blah. Whatever it is, seasoned entrepreneurs, serial entrepreneurs aren't necessarily going out raising shitloads of money just off ideas. The big look, the stars, the outliers certainly are, but there's a bunch of other folks out there who are like having to raise money on the fundamentals of the business. And when I say fundamentals, the actual metrics, actual numbers are expected much earlier than they used to be. Not always, but they are. So that to me sort of suggests actually at the investment level, the venture investment level, it's not at the high end. Yeah, maybe it is frothy, but further down, I don't think it is, which is actually probably
Yeah,
a good thing
I
all in
agree.
all.
Look, in terms of valuations, it's hard to say. Is the valuation high? One of the characteristics that I think there's this 2 components to the market is, okay, if you're a Stanford PhD in computer science and you wrote a seminal paper as an example, right? I'm thinking of a particular person, right? you get some friends together, you kind of like build this little bubble around yourself, you get some top investors, and you go out on podcasts and say, I'm raising $1 billion pre-product. That's frothy. And the reason is, it used to be people like Ilya Sutskever, like what is it? I don't know, Sutskever. I can't pronounce
I
it.
don't know. You're good. Yeah.
Yeah, my last name's Pashensky. I mean, I should be more sensitive to this, but this guy's like, invented AI, and he's like, I have a new AI idea. Okay, give that guy, wherever he wants. Like, sure. Then it's starting to get to the point where it's like they're doing their pattern matching, and so the AI, they say, oh well, what school did Sutskever go to? What classes were he in? And now suddenly you have somebody, you're feeding back the algorithm into itself, where it's like somebody who's like, oh, look at, they're giving, people trying to write $1 billion checks to people who saw Ilya, got into the same major, and are basically trying to look like Ilya and raise Ilya numbers. And then when the VCs give money to those people, this was not somebody who, toiled in obscurity for 15 years and invented this new thing. It's someone who has the same demographic characteristics and was in the same institutions, and they're like, well, that looks like Ilya to me. It's like, no, that's categorically different. This is not a person who struggled for many years and like happened to know a bunch of esoteric stuff when no one else did. This is someone who is now following on, but they're getting the same valuations because, well, if Ilya could do it with $1 billion, then let's give $1 billion to this guy and another, with these Ilya clones. And I think that's where VCs get into a lot of trouble, is when their pattern matching goes from being, it cuts through the noise, to being something which is fed back to itself. You start to get people manufacturing things that look like what VCs are obviously. And I think in some of the base model investments, those $1 billion investments, someone like Brett getting $1 billion, sure. This guy was like in everything. He was like the CTO of Facebook. He was the CEO of Salesforce. He has like insight. He knows everybody. He's well respected. Give that guy $1 billion. Random grad student who had a good paper. Might not might not be as much business savvy. You might be trying to pattern match a little too much. And so I think there's a lot of that. And then there's people who are just going out with business results. I think the fact that you can raise capital ever is a miracle. Like, asking somebody for $1 million, which is, tiny round these days. Like, what on earth? Like, what?
Yeah.
You can ask someone for $1 million, and you look in your bank account and there's $1 million there. Every time, that's a miracle. You ask someone for, 500,000, and they start paying you every month, and you get that $60,000, $50,000 check in your. These are all miracles. I think we live in an amazing, trusting society. The fact that people will write any check is always, I think, for a certain part of the populace, right? Your leftists who are like, oh, the whole thing is fake. It's all just email jobs. It's not real. It's like, I can see that sentiment where it comes from, because even in it, it's just like, I can't believe I get paid to do this. I can't believe this works. I can't believe I raised that money. It's always a shock to me. It never feels normal. So I think it's like, like, are we interrogating our feelings here, or are we looking at financial results? If I interrogate my feelings, it's always just insane. Like, business is weird. If I look at financial results, I think there's a lot of rationality in it.
Well, and that's, the feelings are basically where it gets the speculation and it's the most human of characteristics. So anyway, we've danced around. No, I'll say we've talked around this topic for over 30 minutes, Matt. You danced around your answer. You gave me a maybe at the start. So here we are, 30-odd-ish minutes later. Are we in a bubble or not?
Look, man, I'm running a startup. I cannot come out here and say, yeah, all valuations are way too high. I can't say that. I can't allow that thought to like exist in my head. I'm clearly biased. I was skeptical. We're getting towards the end of the year, and at the beginning of the year, I was skeptical of AI. I was, people were hyping it up, and I was looking at the results, and the results just didn't match. But this year, I don't know, man. It's like I said, there's just so many things. Like, I go look at companies that are worth hundreds of millions, mid-sized companies, and you look at what they do, and you're like, the whole thing's going away. This is gone, right? So is that the bubble? People like, they've just been operating as if this is going to keep, whenever you look at those PE multiples, you say, man, that company has a price earning multiple of 17. Essentially means that they would have to continue to make that amount of profit for at least 17 years and a fair bit more because we have positive interest rates now. Okay, to justify, I'm going to put this cash as an investment in, and then I'm going to get that, a justified amount more. So you're saying like anytime you see a company that has a 17x price to earnings ratio, you gotta say, are the conditions for that company to be successful for the next 17 to 25 years, something like that? Are they going to continue to be the same? I would have a lot more concern about those. And I've made that decision. I have job offers and stuff like that. I'm like, no, I'm doing a startup. I do not see this insane way of working, this extremely labor intensive style persisting. I'm not going to invest my life in it. Now, sometimes you see people who invest their life in it and they do very well and they're making a lot of money. You're like, oh man, did I screw up and do a really hard job of being an entrepreneur when someone's out making just an insane amount of money in an industry that I thought was going to be gone 5 years ago? But what I've seen this year, there's so many companies that are just going to have to absolutely change. And then the question is, can you continue to pay people in those very high paying roles permanently? No. And so it's like, where's the real risk? I don't know.
Yeah. So I'll answer the question as well. No, we're not in a bubble. Why do I get there? Well, we shared some of our thoughts, but is real durable value being created? Yes. Has enterprise value already been created? Yes. Is the technology real? Yeah. And I've seen all three things happen through my own eyes. So this is not speculative. Will there be a correction? Yeah, probably. Right. We'll have overinvested somewhere in something. So there'll be a correction and the newspapers will tell us, oh my God, it's a crash. And we're like, no, it's not a crash. So that said, Matt, I've been traveling, so I don't have an answer to our usual what's hit our desk of interest on the AI side. You might already have shared yours, but what you got?
I think I've already shared mine, and it's the Gemini stuff in the last week. Google is going crazy. I think they have different products, the Nano Banana stuff and the Nano Banana capabilities. LM Notebook, I got to go back to and just start using that all over again because they've added a bunch of function there. So maybe it's like end of year. It always feels like November is when like the big AI stuff gets dropped. It's been a very impressive November, at least for my own thing, which is like, I want my job automated, please. I don't want to work so hard. And I'm getting the stuff I wanted for Christmas, right? Like I asked for it last week and we have it this week, a year ahead of schedule. So
Anthropic dropped Opus 4.5 yesterday.
Yeah, you know what?
We haven't even looked at it.
I haven't even looked at it. Like people are like, oh, it's way better, and there's these Arca AGI and stuff like that it's doing well on these metrics. I can't keep up with it. I'm not going to go sit and chat with Gemini 3 for 2 days like I used to with when a new GPT model dropped. So I just people say it's good. I can't keep up.
In a strange way, I wonder, does that speak to the broader question that we've just been debating here, which is, we're at the start of the year, anything that came out, we're like you and I literally were playing with these things, right? Oh, what is this? How does it? Okay. Oh, that's this thing. It fits over here in my sort of mental matrix of what's going on. Here we are at the back end of the year and we're busy just running our businesses, like trying to capture that enterprise or that value for ourselves. So that in and of itself is an interesting shift over the last 11 or so months.
Yeah. I hope the tariffs go away and interest rates drop and we just we keep this train. We could get in a recession in the next few months. I think the recession would probably not hit the tech sector. I think it's a 2-component model where you have this worldwide AI enterprise segment, and then you have real world. I think job growth is slowing down. You see a lot of indications that there might be problems in the U.S. economy. Ironically, that will probably cause political movement to eliminate the tariffs, which we've already started seeing, which I think are a major drag on industrial growth. And if industrial growth is having problems and tariffs drop, then the Fed will then continue to drop interest rates, which will help the normal economy And I think that's a big reason people knowing the normal economy in terms of the prices people pay and the inflation they pay in their daily lives, if that starts to get bad, and it looks like it is, interest rates are going to drop. And then your price to earnings multiple for these big hyperscalers can then be automatically just adjusted up. And so if you drop interest rates by half, that radically extends the interval over which you can basically recognize future cash flows, right? And so interest
And
rates
draws
coming
more
down,
investment in. Yeah.
if
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 needed.
you
Yeah.
believe investments are going to come down, of course you're going to bid up um, these equities. And so I think it's going to be a weird time, because we're going to have these transnational hyperscalers that really are going to operate independently of the normal economy. So yeah, that's another.
Maybe we need to get an economist on here for the next episode.
Just have a physicist with a half-cocked
Sounds good
famous
to me.
joke is physicists are the second best at everything. Like, oh, cooking,
Okay.
that's just physics. Economics, yeah, it's physics. Come on, man. Just it's physics.
I got a quick engineer joke for you. This mother says to her son, "What would you like to be when you're a grown up?" And he says, "Oh, mommy, I'd like to be an engineer when I'm a grown up." And she said, "Well, you can't be both." All right,
All right. Thanks.
we'll land it there.
Bye-bye.
See ya.